Hey, James, you were quoted on the call this morning saying you'd love to expand the dividend in time and get back on the buyback train. We don't want to sit on this capital, you said. Can you talk about the likelihood of either of those two things happening?
Yeah, it sounds like Carl. I can't see you guys on my screen here, but
yeah.
Hey, Carl, it's interesting. Our dividend is $1.40 a share. We've got 1.5 billion shares, so our total payout is about a little over $2 billion. We just earned $3 billion this quarter. The first quarter we're roughly $5 billion through the first half of this year. So we've made almost 2.5 years of dividends in the first half of this year. The Federal Reserve results showed we had about 300 basis points of excess capital on our CET1 ratio. We'll accrete further capital with the consolidation of E-Trade in the fourth quarter. I'm highly confident we're going to accrete earnings in the third and fourth quarter of this year. So we're already sitting on 6 to 10 billion of excess capital. We accrete higher ratios with CET1 from E-Trade. We've added another 3 billion net of our dividend already this year. So we're talking about 10 to 15 billion of excess capital. Plus we're still arguing for some relief on the PP&R, the way, not to get too weedy about it, but the way it calculates FA compensation. So, yeah, we need to do something with this. We can invest in our business. We want to have world-class technology. We're going to invest in that. We're investing in the next generation of investors that Jim's talking about. That's critical to our future growth. We also should increase our dividend, and we should be back on the buyback trail. Not just yet. Let's get through the new stress tests in September. Let's see how the economy performs in the next 3 to 6 months. But 2021, Morgan Stanley should be doing something with this capital for the benefit of our shareholders and for our clients.
Well, James, let's talk about the growth side, because I think that no one's going to give you credit for a future dividend raise, but they should have been given credit for something you mentioned as a throwaway, which I think is one of the most exciting acquisitions you've made, which is the Solium, because that, again, is sticky assets, and we all follow the stock market here, or else you wouldn't be watching. Tell people what workplace wealth solutions mean, because that's one of my favorite businesses that you have.
Listen, it's a great question. There was interesting story. We had a workplace business. We weren't managing it great. We outsourced it to Solium, which is a company based in Calgary in Canada. They did an unbelievable job. And I don't know if you remember the ads. I remember growing up in Australia watching Victor Kiam with the razor company. And he says, I like the razor so much, I bought the company. And I always love that idea. Well, Solium did such a great job managing our stock plans, we went and bought the company. And so we bought them back, paid about $400 million premium on the Tokyo Stock Exchange. A lot of people thought it was expensive. I could care less. It was a rounding error. What we're buying was a platform combined with E-Trade that makes us #1 in the workplace. So what is workplace? It's where you have money in a stock plan or stock options, and those vest. E-Trade then converts them into E-Trade accounts. We didn't. They went to whatever bank or institution somebody had a relationship with. We can then provide research. We can provide product. We can engage with the C-suite to manage their personal wealth. It's just a great growth story. A lot of money comes through where people are working, and we want to be part of that channel. Fidelity's done a great job in that space. We want to do a great job in that space.